Okay, while we're waiting for people to come on in, because let's face it, it takes time to figure out where we are and what we're doing. My name is Frank Acuna. I'm a partner at Acuna Wrigley & Klein. And while we're waiting for people to come in, what I really want to know is what are your burning questions about IRAs and estate planning and tax planning and all that fun stuff that you want to have answered tonight. So, burning questions that you have, what can we answer? This is a free hour and a half with an attorney, a CPA, and a mortgage specialist. So that kind of stuff doesn't come around very often. You got to take advantage while you got it. Or are you just going to let, yes ma'am?
It's over with, you're fixed.
A child who is disabled and being helped by the federal government inherit any monies from a relative.
Can a child who's disabled and has federal assistance inherit monies from a relative? Not quite IRA planning, but I'll give you the quick answer on that really quickly. No, not if you want to keep your SSI, not if you want to keep your Medi-Cal intact. So what you really need to do is a special needs trust for that child. And that's a trust that's there for that child's entire lifetime. It pays for the things that SSI and Medi-Cal doesn't pay for, and because of that, that stretches their inheritance. And if you've done it right, after they pass away, the federal government doesn't get reimbursed for all the Medi-Cal benefits for their entire lifetime. Okay, we're going to have to we're really hot. So do we get your that question? Other questions that you'd like to have answered before we start? Yes, ma'am.
There was something in the email about your mortgage to reduce.
Something about using your mortgage about reducing taxes. Does that sound like it's really strange?
What if you don't have a mortgage?
What if you don't have a mortgage? You will when we're done with you. Oh, no. We'll talk about how to use reverse mortgages and really make an incredible tax play. And I got to tell you, just kind of a weird story. Tim, Chris, and I have known each other since 1991. Mm-hmm. We took care of each other's kids in the church nursery. The families grew up together. And one time we were just talking about taxes and mistakes that our clients make, and came up and started talking about what about if you had a deduction to offset your IRAs? And back and forth and back and forth. And then we grabbed Kurt Kessler over here from Commerce Mortgage. We'll introduce you in a little bit greater depth in a minute. And you should have seen him. Smoke started pouring out of his ears. Because even though Kurt has been doing reverse mortgages for how long?
Mortgages,
period.
27 years.
27 years in mortgages. He'd never heard two tax nerds talk about mortgage deductions. And the smoke started curling. And there was a time there when Linnell Glissman, my office manager, had to very gently lead him back to his car because he was his mind was blown. So we'll talk about reverse mortgages. Other questions that you want to have covered tonight? Yes, ma'am.
When you did our tax.
Please don't end that. When you did our estate plan, please don't end that with, why did you commit malpractice?
No, what I wanted to know is that if things change, it's so that I need to come in and...
Okay, not quite on IRAs, but have things changed in the last, let's say 10 years in the estate planning world, or 15 years in the last estate planning world? Yes. Hugely. We used to only be able to give $600,000 to our families without having to pay estate tax. That number is now up to $5.43 million. So we can give a huge amount of money to our children. The problem is, for most of us is, if you have children, you don't have money. So don't worry about it. There's also been some changes in privacy rules and all those things like that. Quick rule of thumb, if it's been 5 years since the last time you saw your estate planning attorney, make the guy work, make the gal work, go see him. Blow the dust off the thing, make sure it's still working. Other questions that you want to have covered tonight about IRAs, taxes, and all sorts of fun stuff. Yes, sir.
I'm trying to figure out a way to word this. When you leave, let's say your house to your children or a certain child, is there a way that it's supposed to be worded in a tax so that the government or I'm kind of wanting to discuss, will it trigger the state to?
Let me see if I can, because I've heard this question many times. When you leave your house to your children, How do you keep from getting it reassessed so that the property taxes don't go through the roof?
There you go.
And the answer is, you've got to talk to your tax person or your attorney or even your mortgage professional, because they know these things too. You've got to make sure that after you pass away, within 3 years of the date of death, somebody's taking a look at that and somebody is filing what is called a claim for reassessment exclusion for a parent-to-child transfer. You want the documents written correctly so that it'll capture that, and then you've got to move. If you wait more than 3 years, you lose it. And if you wait more than 60 days after the county government says we want it and you don't give it to them, you may lose it. So there's some time requirements there.
What do you call it again?
A claim for reassessment exclusion for parent-to-child transfer. And it does take some really careful planning, otherwise you can wind up getting your property reassessed. I'll give you just a story that happened, last week in our office. We had somebody come in, single child, dad died in the 90s, mom died in 2003, and the house was still in the name of mom's trust. Because she'd heard that if you have a trust, you never need to talk to an attorney again. Wrong. When mom died, she had 3 years to claim that reassessment exclusion, and she blew it. She blew it by 9 years. We figured it out. She's about to get a supplemental tax bill for $90,000 for the 12-year period, the last 12 years, and forever and ever and ever, the taxes are going to go up based upon the value of the property back in 2003. Ouch! Ouch! Last other questions that you want about IRAs. Yes, sir?
You're defusing the tax time bomb.
Defusing the tax time bomb.
I presume you'll discuss that.
We shall discuss the tax time bomb.
That's what they brought me here.
That's what we're going to be talking about. So now that we've had a couple minutes for people to kind of trickle on in, let me introduce myself. I'm Frank Acuna. I'm an attorney. I am a certified specialist in estate planning, probate, and trust law. And I'm joined tonight by Kurt Kessler, who is at Commerce Mortgage and is a mortgage ace, and Tim Krish, who is I love saying this, he's the senior partner at Mays & Associates. Tim, why don't you tell us a little bit about yourself, about your practice?
After that, thank you. My name is Tim Krish, as Frank indicated, and I am the CEO of Mays & Associates, which is a local CPA firm in Pleasant Hill of about 42 or 43 professionals. And if I can introduce real quick, I have a handful of people from our office this evening. One of my tax partners, Joe Polka, tax manager, Julia McKee. I lost Peter. Oh, Peter, sorry. I don't know how I could lose Peter. Medina, a tax supervisor. And Don Hester is actually our IT director and will be recording this so we can distribute it to those that may be interested afterwards.
Great.
Thank you.
And Kurt Kessler, tell us something about yourself.
Well, I'm the reverse mortgage manager at Commerce Home Mortgage. I've been in the industry for 27 years. In fact, when I say industry, real estate and mortgage, I have my degree in real estate finance. They actually gave that out in San Diego State, and that's what I went for.
Wow.
So I'm glad to be here tonight. Thank you for inviting me.
I have one of those degrees too, Kurt. That's great.
In real estate finance.
Yep.
Wow, wow. And I'm Frank Acuna. Sorry. I'm a certified estate planning specialist, and I'm teasing Tim, but I'm also the senior partner over at Acuna Wrigley & Klein, which just means that I'm going to celebrate my 30th lawyerversary this year. And I wanted to introduce some really important people here. Tony Schiavo is our newest addition to Acuna Wrigley & Klein. He's, how shall we say, soon to be sworn into the bar, which is a wonderful thing. Linnell Glissman in the back is our office manager. She is all things, everything, and is really responsible for putting everything together here. I saw Jackie Klein, who is my partner and does estate planning at the firm. I saw Jill Reidelhofer here. Jill's back there. She's an attorney who does estate planning as well. And I saw Heather Caraher right over there. Heather, we affectionately know, is the mistress of space and time. She runs my calendar and keeps me in the right place at the right time, which is no small task, let me tell you. Did we get everybody from ARK that's here? We're good? Okay. You wanted to know about diffusing the tax time bomb. IRAs are wonderful. They really are. When you're working, you put money into the IRA, the government doesn't tax it. It grows in value if you're working with a good financial person, and there's some really good ones in the room that I know. Great, wonderful. It doesn't get taxed while it's growing. It's a great place to do dividend reinvestment and make it really grow really big. But when you retire, you've got a large pot of money that's never been taxed. And it's going to be taxed when it comes out of that IRA. Either you're going to take it during your lifetime as distributions, or your kids are going to inherit it, and they're going to have to take distributions at the same time they're at their highest tax-paying years. And so it's a tax time bomb. It's just out there. And what makes it tougher, I'm an estate planning attorney. We're not so worried about estate tax anymore in most estates, but what I see is clients over and over and over again who tell me, well, I'm not working anymore. I don't need a tax professional. I don't need to do tax planning. And I'm looking at IRAs that are going to be taxed at the very highest state and federal tax rates. So what we're going to be doing today is taking a look at some scenarios, taking a look at just some of the strategies that can be used, and there are many, many more. But we wanted to hit some of the better ones. Here we go. Let's find out where we're at. This is the commercial message. Every family needs a team of financial professionals. You need a tax professional. Probably the first professional you need in your life. Then your financial professionals, whether that's working with your mortgage or your finance, your insurance and investments. The least important person in the crowd is probably the attorney. Our job is just to make sure that what these other guys have done works together so it can go to your family with the least amount of loss from either family squabbles or taxes possible. But here we go. I'm going to ask Tim to talk about just what is the turf in terms of taxation on IRAs, whether it's estate tax or income tax.
Thanks, Frank. Okay, the big question tonight is pretty much diffusing the potential tax bomb, if you will. And Frank's already indicated that in many respects, since the IRS and Congress, et cetera, approved the increase in the lifetime exclusion from, it had been ramping up for a number of years, but they set it at the $5 million mark, and then it's adjusted hopefully annually for inflation. And for 2015, we're now at the $5,430,000. And that's, the good news is, if you will, that amount could pass to your beneficiaries free of estate tax. The big question has to remain is, is the current law permanent? And about the only thing we can really count on nowadays is the IRS is going to change it. Since President Obama has been in, well, yeah, I was trying to think of a different term for it, but since he's been in office and remained, since he's been in office, I had read recently that there had been nearly 9,000 tax law changes enacted. And that's individual partnerships, corporations, trusts, estates, etc. So although that's good news for tax preparers, it makes it somewhat of a moving target. And I believe you had asked, well, should I have my estate plan re-reviewed or revisited? And like Frank said, every, I say 3 to 7 years, depending on what's in the news, it does make sense to have it reviewed just to make sure that what you set out to accomplish still remains in place. Families change, the tax laws change, and there's always something going on that we don't know how it's going to impact the Fed or the state tax laws.
Next one.
Please. Okay, so this is a slide meant to kind of scare us into action, if you will. If an IRA, and I'm going to talk about an IRA that hasn't been, doesn't have a named beneficiary directly, and it goes into an estate, that's when we begin to panic, because the IRA would be taxed potentially at the 40% level for federal taxes. When it was then distributed to the beneficiaries from the trust, it could be at risk of being taxed at the highest brackets for those beneficiaries. So as you can see, the highest federal rate these days is in excess of 43%. State of California is a little better than 13 for a combined 57%. And although when taxpayers tell me that they don't like being in that tax bracket, I remind them of what they're earning. So, but the bad news is if you get the double whammy, you can literally lose on an IRA distribution a combined 74%. And that's a real extreme example, but hopefully that grabs your attention.
So what do? We're going to talk about 4 solutions today. The 4 solutions we're going to talk about, and these are all kind of, Kurt and Tim and I see these all the time in our practices. The 4 solutions that we really want to talk about, first of all, the mistake of leaving your retirement in a 401k, 403b, or 457 when you have the option of rolling it into an IRA. So many more options in the IRA. Second, making sure that you've designated the right beneficiaries, and that may change over time. Third, RMD planning, required minimum distribution when you're 70 and a half or over. And the big mistake that I see in clients over and over and over again is, oh, I don't want to pay any tax. I'm going to take the bare minimum out of my IRA. That may not be the best solution. And then finally, the one that you've been asking about is, how do you use your mortgage as a way of reducing taxes on an IRA and increasing the wealth that you can transfer to your kids? It's going to be fun. Here we go.
Question?
Sure.
Are SEP IRAs in this category you're talking about, or is that separate?
SEP IRAs are in, they are a flavor of IRAs, and they are okay. They don't have the same limitations that 401ks do. And I'll show you some of the 401k limitations that we're trying to avoid. We have a lot of clients who work for the University of California, United Airlines, Pacific Bell, PG&E, boy, what else? Chevron, my favorite. And they have huge retirements locked up in 401k. So Al works for the airlines as a highly skilled mechanic. His company has a pension and a 401k. They have matching. He's been pumping money into it his entire career. And as he's getting ready to retire, there's talk of a merger, there's talk of layoffs, there's even bankruptcy being bandied around, and his 401k is controlled by his company, which means that it may not be doing as well as the economy at large because it's being administered by the company administrator rather than having Al determine what's going on. So what can he do? Okay. First thing that I would be doing is talking to Tim about rolling your 401k into an IRA. Why would we want to do that? First of all, because Al, instead of relying on the administrator of the 401k to make investment decisions, Al is now in charge and can work with his tax professional and his investment advisor to come up with the right investment strategy for him. Second of all, most 401ks, 403bs, 457 plans, not so much SEP IRAs, but the others, will have limits on what investments you can invest in. At our firm, we have a 401k, and it's limited to just certain fund families. Now, the fund families that we have are pretty good, but there may be better ones out there. We may have more options than just that particular bunch of mutual funds that would work better for what we're trying to do. Can't do that in a 401k. You're stuck with the options that are presented. So moving it into an IRA, we remove the limits on the investments that we can make. Then we can remove limits on withdrawing from the 401k and on the management of the 401k, and we can provide a lot more options for tax planning. There's just some things that we're going to talk about tonight that you can't do with a 401k, 403b, or 457 plan. So hugely important as we near our retirement. After we retire, can't do this while you're working for the company, but after you've retired, you can roll out of the 401k and roll into an IRA and get so many more options, so many more possibilities. So that's solution number 1. Did you want to talk about beneficiary designations? You want me to go through the...
You can kick.
Okay, I'm going to go through the yes, sir.
I have a question.
Please.
You say roll over to an IRA, are you talking about a traditional IRA or an investment IRA?
One and the same.
One and the same thing.
So if I go to the bank and I put the money in the bank, I don't have any, I mean, they give me 2% of whatever it is, some stupid amount. So if I go to an investment firm, don't they invest in either of the stocks?
With an IRA, you can choose who you're going to work with. You can choose whatever investment company, Fidelity, Schwab, Wells Fargo Advisors, whomever, or you can choose a bank. The point is, with that IRA, you get to choose who your investment advisor is, whereas with the 401k, you're stuck with whoever the investment advisor is with that 401k. You have no choice whatsoever. Okay, beneficiary designations. Fred and Wilma. Can you tell that I love cartoons? They're in their 90s. They have a sizable estate, $8 million, which they're going to pass to their kids. They'd like to give something to each of their grandchildren to assist with school and give them a head start on purchasing a home and starting their own families. They'd like to give about 10% of their total estate. Part of their net worth is $1 million in their IRAs. What would you do with them? Those grandchildren. By the way, does anybody know the legal definition of what is a grandchild? That is someone who shares your DNA, who you like a lot more than your own kids. So I get a lot of my clients who really want to help the grandkids out. Here's what they could do. There's 3 different beneficiary designation strategies we're going to talk about here. One is naming individuals or charities as beneficiaries. In most cases, not their trust, or for heaven's sake, not just leaving the beneficiary designation alone. Second thing, stretching by gifting to future generations. And thirdly, using charitable beneficiary designations on their IRAs instead of just giving money from their trust to the IRA, and then the kids get name the trust from, oh boy. Name the charity as the beneficiary of their trust. That's the mistake. What would be better is naming the charity as the beneficiary of their IRA. So let's talk about how that works. Charities versus, oh wait a minute, I'm going to move back a bit. Let's see if I'm going to go back here. Okay, just to elaborate. Why, oh wait a minute, I think I did this right. Did we do charities first?
No, it'll go next.
It'll go next? Okay. I want to talk about stretching. Yeah, let's talk about stretching and then we'll go back to charities. Naming individuals or charities as beneficiaries for IRAs is so much better than naming nothing. And I see a lot of families in our practice that name their husband or their wife as the beneficiary of their IRA, but they never name the follow-on, the continuation. So great, I die, my wife gets my IRA. My wife's in the crowd. She's going, woohoo, I got it. Great, wonderful. But what happens if something happens to both of us? Then we have nobody designated. And then we've got a problem because we're going to have to go to court, have a probate to figure out who gets the IRA. Not a very good solution. What would be better is naming the kids or the grandkids as the beneficiaries on that IRA. Why? Because then we don't have to go to court to determine who's going to be the beneficiary. But if you really want to take care of the grandkids, for heaven's sakes, instead of giving them money from your trust, name them as beneficiaries on your IRA. Why? Because if you're over 70 and a half and you're naming beneficiaries, if you name a child, that child has to take the IRA distributions over their lifetime. And the way it works is you look at their actuarial life. Let's say that their actuarial life was 83 years. Then if they're 65 years old, this year they would take 1/18 of it, next year 1/17, then 1/16, then 1/15. Okay, 1/18 works out to about 6%, roughly, 5.5%, 6% of that IRA in the first year, which means you're not going to pay a whole lot of tax. It's not going to be that much income, but you're also not going to have a lot of tax-free growth. If you name the grandchild, who's 25, they again have to take the minimum distributions based on their actuarial life. But again, if they have that same 83-year-old actuarial life, that means that this year they only have to take 1/58 of the IRA, which is less than 2%, which means if they got a good rate of return in their IRA, they would get all that lovely tax-free growth again. So that's huge. That is wonderful.
Never tax-free. tax deferred.
All right, all right, all right.
We
I
wish it
give
was
you the
free.
accountant. I like tax-free better.
Could I name a minor?
Can you name a minor as the beneficiary? Yes. But if you're going to do that, we're going to do something that we're going to talk about in a little bit called a conduit trust for the IRA. We're going to put some controls on them because let's face it, who wants to give an 18-year-old $100,000 or $200,000 or more in an IRA? We want to control them. So we're going to show you how to do that. Charitable beneficiaries, though, this is really cool, and I want Tim to explain this.
Thank you. Let's go through the example first, and we've scaled it down here a little bit. Chip and Sandy have been active in their church their entire married lives. They have just one son, Chuck, and they have a home worth $500,000 and an IRA retirement account worth $100,000. On their deaths, everything goes into a trust, and that particular trust happens to provide for a $100,000 gift to their church, and then they leave the balance to their son. The charity would in fact receive $100,000 because that's what the trust document has identified as being the donation to the church, and Chuck would end up paying, it's actually closer to $40,000, I believe, in income taxes on that $100,000.
But see, that's what happens when you name Chuck as the beneficiary of the IRA and the charity as the beneficiary in the trust. Now what happens if you turn it around, Tim?
Much better scenario. If we designated or recommend that they designate the church as the primary beneficiary of the IRA, and then, yes, Chuck does get the residence or the remainder, the result would be that the charity still received the $100,000 and they wouldn't pay any income tax on the IRA they receive, and Chuck would receive the $500,000 instead of $500 less the tax. So the $40,000+ would be saved on structuring it this way.
What I think is really cool about that is that the federal government and the state government kick another $40,000 plus into the pot, and there's absolutely no loss because of the income tax effect on the IRA.
I don't know if there's a wind blowing
I think
here.
you're getting maybe a
Yeah, I
little bit
think
right up here. Wow.
The air conditioning's working.
If you see Dorothy and Toto, that's it. We're out of here. Okay. You asked the question. So questions about naming charities as beneficiaries on IRAs. We're all good with that?
And I've got to say, we work with about 150 different nonprofit organizations in this area, and they love this structure.
And let me put in a shameless plug. Tim is a member of the board for the Animal Rights Foundation, for ARF. I would much rather see puppies and kitties taken care of than sending it to Uncle Sam. I'm just that way. Somebody had a question over here.
So instead of passing it on to your heirs, your children, grandchildren, you're suggesting that some of this money goes to the charity.
I'm just suggesting if you have charitable intent, the best tax play is by giving the charity money that would be otherwise income taxed.
But if you do not,
If you don't have charitable intent, you need to adopt me. You need more beneficiaries.
children and grandchildren, at least what I've read.
So great, okay, then children and grandchildren, that's wonderful. This is just a strategy. Not all of these strategies work for everybody. This one works if you do have charitable intent, whether it's your school, your church, hospitals, puppies and kitties, whatever. It's just a great, great way to think about your estate plan if you have charitable intent. Okay, yes, sir.
This is also called a charitable remaining trust.
No, charitable remainder trust is a little bit different, Rod. A charitable remainder trust is when you donate property to a trust, a special kind of trust that's going to provide a charitable benefit. And we can use that as a way of killing the capital gains tax on selling real estate or stock or whatever. This is just strictly using the beneficiary designations on an IRA versus a trust. Just picking it on the right way. Now, this was the question that had to do with, do I give an IRA to a small child? Look at this. Lee and Harry are in a second marriage. Each has 2 adult children from their first marriage and a 5-year-old joint child. Harry has a substantial retirement account. I mean, it's there. And he wants to make sure that 3 people each receive 1/3 of the IRA. But he also wants to make sure of a couple of things. He's got some special issues in his family. First of all, He wants to make sure that his wife's access is restricted. He's worried that she's going to inherit his IRA and just blow it. Now I'm seeing every woman in the room going, hey, don't mess with that. Just saying. Second, he's got an alcoholic son. This is an adult, but this son has never been able to get clean and sober. And he's afraid that if this son inherits, it's all going to be gone because he's going to go on one enormous tear and there will be nothing left. And then, of course, he's got the youngest child, and he really wants to give this youngest child, this 5-year-old, a chance to grow up, to mature, to get his feet underneath him before he gets access, before he gets control of all that cash. What do you do? Okay, for him, he wants to make sure there's some controls until that son turns 30. One of the cool things that's happened, I think, what is it, about 5, 6, 7 years ago, there was a ruling by the IRS that says you can now put IRAs into trusts as long as they meet certain specified criteria. In the old days, 2005, in the old days, if you named a trust as the beneficiary of an IRA, you had to take all of the IRA out, recognize it all as income within 5 years of the date of death. That's not so good. That's a lot of tax paid at the very, very highest rates. And the IRS finally said, nah, you know what? That's not the greatest solution. So the old rule was the 5 years, was the 5-year rule. The new rule is that you can create a trust where if you name the beneficiary of the IRA in the trust, you name the measuring life, you can go ahead and put conditions on when the trust pays out. But the trust will then go ahead and they'll use that beneficiary's lifespan. Remember we'd said that they had to take so much per year, but now instead of having to take 20% a year, now they can take it based on their life. So that 5-year-old child, if that 5-year-old child has an actuarial life of 83 or 84, we're talking 78 years, so they only have to take 1/78 out. And that 1/78 can be kept in the trust and then doled out for whatever specifications that you've got. So for example, for the wife, for Lee, you can go ahead and put conditions on it that she's entitled to, for example, all of the RMD, all of the required minimum distribution, and can take out more if she needs it for her health or education or support needs. For the alcoholic child, you can put it in there that they're going to have a budget of X number of dollars a month and that rehab will be paid for if that's what you're worried about. And for the little one, great. It's there for their education, it's there for their support, but they don't get their hot little hands on it until they're 30, and at age 30, the trust dissolves, and now they can go ahead and take over the IRA directly in their own name. Yes, sir?
If you already have like a trust, revocable trust set up, is this a separate trust, or is this part of your, could be added to an existing?
Question is, if you already have a revocable or revocable trust set up, can this be part of your trust? And the answer is yes. This is a great thing to do, to amend your trust to go ahead and put these controls in. This is another one of those changes that's happened in the last 10 years. So if you have small children, small grandchildren, maybe with grandchildren what you'd like to do is something called an accumulation trust, which means that the RMDs come out, but they stay in the trust. They just keep accumulating until that grandchild gets to college, and then bam, go ahead and spend it all on their tuition. Wonderful, you can do that. You can say, oh, when they're out of college, we can flip it and make it a conduit trust, meaning that they take the RMDs and they just move like right through a pipe right to that kid, and they get the income. Great, we can do that. We can make it a kind of a hybrid, which says, okay, they can have the RMDs as income, or part of the RMDs as income, but you know what? When my grandchild turns 25, I don't want them to have control of it, but I do want them to have that for something else. Why not let them take it out of the trust to buy their first house? You can do that. So these are the kinds of things that you can do by naming a trust as a beneficiary, as long as the trust is the beneficiary for the benefit of my spouse, my child, my grandchild, my friend, whomever. Okay? So this is a huge change in the tax law having to do with putting IRAs into the trusts. You're looking at me like, whoa, you can do a lot with a trust, can't you? Honest to goodness. There's only 3 things you cannot do with a trust. One is you cannot mess with a person's reproductive rights. You can't say that they have to have children, they can't have children. 2, you can't say that they have to get married or they can't get married. 3, you can't commit a crime with it. Other than that, we can make trusts do almost anything. How are we doing so far in conduit trusts? We good there? So we've talked about proper IRA designation, or we've talked about rolling out of the 401k into an IRA. We've talked about proper beneficiary designations, and we've given you some ideas here. Get ready for the next one. Required minimum distribution planning. And I'm going to put in a shameless plug for the tax professional in the room. Because honest to goodness, this is where most people are missing it. They're so hung up on not paying any tax that all they do is take whatever the company says is their RMDs. Tim, you want to jump in?
Sure. All right, in this example, Bob's 85 and his wife is 83 years old. They've lived carefully and have been getting by on Social Security, a small grocery pension, and saving interest, dividends, etc., about $38,000 a year. Bob's children are assisting them and are careful to manage income taxes by taking only their required minimum distribution each year, that being the RMD. Bob's doctor, unfortunately, has given him a dementia diagnosis and is prescribing placement in a dementia facility. The family plans on selling the house and to pay for Bob's $6,000 monthly care bill with the proceeds. Okay.
Tim, can you explain what RMDs are and how they work?
Absolutely. The required minimum distribution is the IRS's way of saying you can't continue to defer the tax, period. Once you hit age 70 and a half, you have to start pulling the money out of whatever retirement accounts you have, whatever bucket, and that's IRAs, SEPs. If you're still working and have 401k plan in place, it all, well, I take that back. If you're working and you have a 401k, you don't have to start distributing out of that yet, so I strike that one, sorry. But the IRS says it's no longer up to you. We're going to mandate that you pull it out and it becomes taxable income. You fail to pull it out, it's subject to a 50% penalty of the amount that should have come out, as well as the ordinary income tax on it. So it's a horrible gotcha.
So if you have a 25% income tax and a 50% penalty, you're going to lose 75% of what you were supposed to.
From that required minimum distribution.
Wow.
Correct.
Let me ask you just a question that we don't even have on a slide. Let's say that you've worked in different places, you've opened up different accounts, and maybe you have 3 IRA accounts and a 401k, and you're no longer working, and they tell you you've got to take your required minimum distributions. Do you have to take a percentage from each of them, or can you pick and choose which plan?
You can pick and choose, as long as what the taxpayer needs to look at is, as of 12/31, in our example today, 12/31/2014, what's the grand total of all the investments within those accounts? And then based on what the IRS says you're going to continue to live, in a previous example it was 18 years. Well, if you're 70 and a half, it's a shorter period now. Divide the lump sum by that amount, and that's what you have to pull out by 12/31 of the year that we're in.
But I'll tell you the 2 mistakes that I keep seeing. I either see taxpayers, my clients, who say, oh, I've got to take this RMD out, and so they take a percentage out of each account based on what that account is as part of their total retirement picture. So they're maybe taking monies out of their best performing retirement account, or they get the notices from 3 different fund managers or 3 different financial accounts, and they take the RMDs from all 3. So they're taking triple the RMDs without even thinking about the planning involved. So there's a couple of different mistakes that are being made there. Yes, ma'am.
Similar to your example, my friend's mom has dementia, and there was a failure to take out the RMD, and she now has a professional fiduciary, and I think they had a workaround to waive that.
There certainly is. It's been pointed out to me recently that it can be appealed with the IRS.
Okay.
especially, and based on facts and circumstances, it can be reversed.
Death and disability are the two principal ones. Other life-changing events sometimes can give you some sort of basis to get out of there. But
It may take a while, but they will listen.
and planning is always better than having to scramble. Okay, so here we go. Well, do you want to go ahead and go through those?
Sure. All right. So taking only the required minimum distributions potentially subject the kids to higher income tax rates when they actually inherit. And we saw that with the previous example of parents versus the children. One of the solutions that we would explore or recommend would be on an annual basis determining the maximum amount that could be withdrawn and still remain in the tax bracket that they're in. In our example with, I'm sorry, I don't remember.
38,000.
No, I was trying to remember their names, and all I could think was they sold the house out from under Carol. But we could ratchet it up, and instead of just taking the bare bones required minimum distribution, they could pull an additional $3,000 a month, remain in the low 15% bracket for federal purposes.
Before you go on from that, Tim, I wanted to just kind of pull that out a little bit. This couple had $38,000 of adjusted gross income. That's in the 15% tax bracket for married taxpayers. The highest amount that you can take without going out of that 15% bracket, without paying a bigger proportion of tax, is $73,300. That's where that additional $35,300 could be taken out without paying higher than 15%. Why that's so doggone important is, imagine, if you will, that their kids are paying taxes at the 35% federal tax bracket. All right, that means that IRA, if it's inherited by the kids, you're going to lose 20% in needless tax. If mom and dad would have taken that money out and paid at the 15% bracket, they would have saved a ton over the kids paying at the 35% bracket. So you've got to do some intergenerational planning here. You got to take a look at what's the kid's situation. I wish I had to worry about income taxes as much as this, but honest to goodness, many of us do. Many of our kids do. So why, so it's a little bit, it's a hard sell sometimes for mom and dad to realize, you know what, my tax rate is cheaper than my kid's tax rate. I really should be taking the most I can in my bracket.
And this is...
So if you still want to leave it to your children, so you just put it in the savings account?
Yeah, put it in a savings account. Turn it into a Roth IRA. Do whatever you're going to do.
Talk to your investment advisor. Let him or her put it to work.
And if your investment advisor is not talking to your tax advisor and vice versa, or even worse, if you're not talking to your tax advisor every fourth quarter, November, December, about how much you should take out of your retirement account, you are leaving money on the table that the IRS is going to scoop up. Pure and simple. This is why I get a little unnerved when I get so many of my clients who say, I'm not working anymore, I don't need a tax professional. Oh, yes, you do. When I look at those retirement accounts, you sure as heck need to talk to your tax professional now more than ever.
And this is somewhat of a challenging example, but it's pretty, unfortunately, common these days where an individual does require additional care or assisted living even that qualifies for tax deductibility. Families don't make great decisions when mom or dad get the diagnosis that they can no longer live on their own. So that's a heck of a time to start trying to figure out the last thing you're going to do, or any family's going to do, is think about the tax consequences. All they care about is, are mom and dad going to be okay, and how do we move forward? An alternative consideration with the impact of dad having to go into a medical memory long-term care need is the fact that in our example we're saying $6,000 a month, which is probably about 50% light in California, closer to 9+ per month. But we're looking at a medical deduction just for that living requirement of $72,000 per year. From a tax planning perspective and, and from an investment advisor's perspective, we would be looking at what additional dollars could come out to be offset by this massive deduction. And if we planned ahead such as this, then we wouldn't have to worry about selling their residence and Carol being homeless. So there's a lot of considerations here that, unless we've done some planning ahead of time, talking with adult children, et cetera, to play out the what ifs, some bad decisions can be made.
So the bad decision that I keep seeing all the time is mom or dad needs to go to memory care, adult child is taking over, is helping with their finances, and is so panicked about paying taxes that they don't talk to the tax professional. I'm not going to touch the IRA. I'm just going to take the bare minimum. But they have these stock accounts, and I'm going to go ahead and liquidate the stock accounts, and I'll use that to pay for the memory care. That's a double whammy. Because number one, you're going to pay capital gains tax on those stock accounts if those stocks have appreciated in value. Or even worse, I'm going to sell the house. Mom and dad bought that house for 35 grand, and it's now worth 700. That's far in excess of the $500,000 exclusion. So now you're going to be paying capital gains tax on the sale of the residence, which you wouldn't pay if you waited until after mom and dad passed away. Now do the right planning and say, okay, that's $72,000 additionally that I could take out of the IRA without having to pay tax on it because I've got a corresponding medical deduction. Now look what we've got. We had an additional $35,000 in the 15% bracket to begin with. Now an additional $72,000. We're now up at $107,000 conceivably that we could have pulled out of that large IRA without having to worry about the income tax. It's a little bit less than that. There's some massaging in there because not everything on a medical deduction is deductible. There's a floor. And how much is the floor now for over 65?
7.5% of your adjusted gross income.
So you're going to have to do some calculating, but just in gross terms, we're talking about conceivably what could be $107,000 that could have been taken off the table as far as taxation or excessive taxation of the IRA. Okay, you've been waiting for this. Yes, sir.
These minimum distributions, let's say somebody has been taking these minimum distributions when they reach 70.5, but they never see a check for it. They just tell their broker they have standing orders to reinvest it because they don't need the money. Is there a problem with that, and could they have a problem with the IRS?
Nope. There isn't a problem as long as it actually came out of the IRA account.
The question is, what happens if I take money out of my IRAs and I've got a standing order with my broker to just go ahead and reinvest it? And the answer is just, that's fine. That's fine. You don't have to spend it. You just have to take it out. However, if you really, really, really want something to do with it, I'm here for you. That's commercial message number 2 for the evening.
And there's another benefit of that, of pulling it out and reinvesting it, in that upon your passing, there will be a step up in the basis of those assets. So your beneficiaries could benefit even further.
So let me give you the great play on this. Remember, we said that there was $107,000 on the table. Let's just talk about the $35,000 extra you could have taken. You take that $35,000, you give it to your broker, you give it to your financial advisor, you say, invest for me. And they do a phenomenal job for you because now you've given them some money to really get in there and invest for you. Okay, they invest, they make it grow. Anybody know what the S&P 500 has done since 1926? 10.3% year in, year out, and that includes the crash of 29, the correction of 86, a bunch of recessions along the way, World War II, the Korean War, what have you, the tech wreck, the mortgage meltdown, and still the S&P 500, the total rate of return with reinvested dividends is actually 10.38%. Anybody know what the S&P 500 has done over the last 10 years?
17%?
Nope. Believe it or not, and you're thinking, oh, 2007, 2008, it died. No, over the last 10 years, 10.1%. That's the total return over the last 10 years. So taking the money out of your IRA, where it's still going to be income taxable, but doing it while you're in the lower tax brackets, and now investing it, Tim's right. If you invested now and it's worth this much, but it's going to increase in value by 10% a year, that means that if it's taxable money, it'll double what, every 10.4 years? Okay, great, wonderful. When you pass away, if the goal is to give that money to your kids or grandkids, you do get a step up in basis for capital gains tax purposes. So if the kids liquidate that stock portfolio, they pay no tax. Whereas if you would have just left it in your IRA, they would have had to pay the income tax on it. So it's a much better play to recognize the income tax in, I'm now mom and dad, in mom and dad's estate rather than passing on that ticking tax bomb to the next generation. For those of you who are younger in the crowd and you're trying to get your parents to think about this stuff, you're welcome. Yes, sir.
If you're going to become 72, that's where you have to take the mandatory amount to make your
70 and a half.
70 and a half.
I don't know where the IRS came up with this stuff, but they said that if you take it out before you're 59 and a half, you have to pay penalties, and if you wait until you're 70 and a half, then you've got to start taking... Who's got a 70 and a half birthday? I haven't had a half birthday since I was 6.
So what I'm getting at, so you're set up, you're retiring, you're going some years, and you're drawing so much out of your IRA. And it's sort of, they have a name for it, but it's a set amount. That's what you're...
That's the required minimum distribution.
If your financial guy does better, the goes up, and if he doesn't do that well, you might lose a little bit. So now you come around 70 and a half years old, and they're going to say you have to make this come down. So what if I get a set amount? They say, all right, I'm going to draw the set amount, minimum amount, and my guy does well, and it still goes up. Do they every year look at that and say...
Every year they look at the total balance of your IRA, and every year they give you the new RMD calculation for that year.
So
that's why I'm saying...
...into another account, so you just not...
That's why I'm saying every year you need to get with your tax professional, and if you don't have one, you should get with Tim, and you should really do that kind of planning every year. Honest to goodness, it's huge to do this kind of planning because there's so much money you could be leaving on the table. Okay? All right, let's talk about reverse mortgages. And Kurt, we're going to ask you to kind of go over and expose kind of fact and fiction, what reverse mortgages are, what they aren't, what they can do, what they can't do, and then we're going to throw you to the wolves. We're going to throw you to the attorney and the tax professional to pick everything apart. So here we go.
We didn't practice that.
I know, but believe me, they're going to be really entertaining.
Trust me, it'll be fun.
Wow.
No pressure. It's okay.
The two guys in white shirts, yeah.
Yeah. Oh, okay. Thanks for throwing me off my game.
Yeah.
Okay, I'm going to go over the myths, a little bit of information about reverse mortgages, and then get into the stuff that I really like, the benefits of a reverse mortgage that most people don't know, the 3 major benefits that really gets my juices flowing, and one of them is one that Frank introduced to me, he talked about at the beginning. So first of all, the lender owns the home. That's a myth. That myth has been around since the early 80s because there's a company in San Francisco that financial company that works out of a pyramid building that offered reverse mortgages where they shared in the equity of the home. In about 1988, 1989, the Reagan administration said, let's look at this because the seniors are a protected class and we want to make sure that their most valuable asset typically is their home is protected also. So HUD got involved, FHA started insuring reverse mortgages, and ever since then it's just a lien against the house. It's regulated by FHA. Governed by HUD. So rates, fees, guidelines is all set out by the government. It's not the investor, but they're the insurer, and that's the only way we can get it. There are non-FHA reverse mortgages, but FHA makes up probably 99% of the market. And you'll hear the term HECM, Home Equity Conversion Mortgage, and that's FHA's jargon for reverse mortgage. So myth number 2, the home must be free and clear of any existing mortgages. Again, a myth. About 80% of the loans we do for seniors have an existing mortgage. They want mortgage payment relief, and that's what they're using the reverse mortgage for. Now, in many cases, you can qualify for more than the actual current mortgage is, and that creates a line of credit if we structure it that way, and we'll get into that in a minute. Yes?
You know, I just wanted to throw out, this is a very, very, very typical scenario in our practice. We get spouses who are in their retirement years, first spouse passes away, and they still have a conventional mortgage on their home. One of the horrible things that happens is you're going to lose one of their Social Securities. You're going to lose the lower one. So now what was okay when they both had Social Security, they were able to make their mortgage payments, is now really, really, really tight. So Kurt, what would you do in that situation to make the home affordable there?
Reverse mortgage.
Why?
Because it eliminates the payment, and it's going to give them payment relief. And typically, at that point, there's going to be enough equity that they're going to get the money they need, and depending on the equity position, we'll get into that in a minute, it creates a line of credit, or it can if it's structured properly, that becomes an emergency fund for future use. That answers the question?
Yep, great, thank you.
Myth number 3, once loan procedure receives, they're taxed. That's not true. Money from a reverse mortgage is a debt. It's not a taxable event. So I get asked that a lot. Number 4, the borrower is restricted on how to use the loan proceeds. Again, not true. You'll see in the documents, if you do get a reverse mortgage, they will have a disclosure asking if you're buying or getting this to get an annuity, and they advise against it. But there is nothing in the documents that says what you can and can't use this for. And the reason that's in there was a company out of New Jersey that was trying to sell reverse mortgages to buy annuities. And it wasn't a good deal for the homeowner, it was just a good deal for the loan officer / annuity salesman. So that's in there. But what I like about it is the creative ways that I've seen my clients use the reverse mortgage. A gentleman in San Francisco pulled a line of credit. His home was free and clear, and he used that to bank buying foreclosures and flipping them. He did about 3 homes. He did it as kind of on a lark, but he knew there was enough equity in the purchase that he made money on those, and he just paid off the line of credit, the reverse mortgage line of credit, so he used his house as a bank for the transactions. My other favorite story is that I had a couple in their late 80s in South San Francisco that had a reverse mortgage in place, but interest rates had dropped and property values had gone up, and so we could do a heck'em to heck'em, a refinance of a reverse mortgage into a new one, giving them a lower interest rate, but also allowing them to pull some money out because they had a bucket list item. They wanted to go on a world cruise, a 115-day world cruise, and they used the money for that because they didn't need the money for anything else. But we were able to lower the rate too at the same time.
Kurt, before you go on, you just said something that I hadn't heard before. You can actually get a reverse mortgage to refi down the interest rate in your
existing... Or pull money out.
Wow.
Yeah.
Okay.
And we've seen a lot of that in the last 2 years because rates have dropped and property values have gone up. And if they got them in 2008, 2009, it creates that opportunity. As we see interest rates going up, which we probably will at the end of this year, the Federal Reserve's talking September, depending on who you believe, but it'll probably go up, that opportunity might dissipate. But the other side of the coin is if the property values have gone up, it may create that opportunity. And then number 5, it's a loan of last resort. And some cases it is, but we're seeing more and more people utilize a reverse mortgage as a tax planning and retirement planning tool. And a good indicator of that is the average age about 5 years ago for a reverse mortgage was 76 years. It has dropped down to 70.5 years. I think it's interesting it corresponds with that, but it's dropped down. And we think it's going to continue to drop down because financial planners, CPAs, and state attorneys are starting to recognize the benefit of a reverse mortgage and how it can be used in a holistic approach to retirement planning. So, done with the myths, we're going to just jump into just some basics. You have to be 62 years or older to get to borrow against the equity of the home. You don't have to give up title, that's number 1 myth. You don't have to sell the home or take a monthly mortgage payment. There are no, yes?
Do both owners have to be 62 for the husband and wife?
That's just changed. There's a non-borrowing spouse clause that if they are not borrowing, but they are on the title. And so one of them has to be. But when we calculate how much you get for a reverse mortgage, it's based on age. And what they'll use is the youngest spouse's age. So you'll get less money. Because a reverse mortgage, the calculations use basically an actuarial table to determine how much money you'll get. So it's your age, current interest rate, and the value of your property. And then we come out with what we call the principal limit, and that's the maximum amount of money you can get. And that's for a HECM. There is another that we're not talking about, but there is a jumbo reverse mortgage that we're in this area that we're starting to see a lot more because property values have gone up so much. No monthly required payments. It doesn't mean you can't make a payment, but they're not required. The time the loan is repaid is when the sale of the house or refinancing of the home. Now, the sale of the house or refinancing, repayment of that mortgage has to happen if both borrowers have moved out of the house permanently. So after 12, and that permanent is determined by 12 months. So once you've moved out, 12 months, then the lender's going to say it's time to repay the mortgage, and that's when they get their money.
So that could be death, or that could also be when both borrowers have had to go to assisted living or a skilled nursing facility or dementia care.
Right, but when you get in assisted living, sometimes they come back home. So it's got to be beyond 12 consecutive months. Okay. Yes?
If you suddenly decide after you've done a reverse mortgage, you really don't like living in the state, want to move to a cheaper state or something, you can sell it and just pay off whatever you borrowed?
Yes.
Now,
Yes.
if you haven't taken any money from the reverse mortgage, it's just more like a hedge for the future?
Right.
Do you owe anything?
If you've not pulled any out and you haven't financed your closing costs, then no.
Okay.
And I'm going to talk about that in the next slide a little bit, that strategy.
Ready?
So there's no maturity date, meaning that it's not a 5-year note, it's not a 10-year note, it's a 20-year note. In reality, what they will do is put a maturity date on the note, and it's going to be the age of the youngest borrower when they turn 150 years old. And the reason they do that is they just have to put something, it's a form that they have to fill out, so they use that as a, so if you're 70, you got an 80-year mortgage. So it really just depends. So really no maturity date. It becomes due when a borrower sells a home or permanently moves out of the home. Now, and this goes back to what I talked about with the investor buying foreclosures. There's no prepayment penalty. You can, on a line of credit, because you can do a fix or line of credit, the line of credit you can pull it out, pay it back, pull it out, depending on what your needs are. So, next. And this is where I get really excited. These 3 ideas. The first one, everybody's probably familiar with a home equity line of credit. You've probably had it, and if you did have it in 2008, 2009, you probably got a notice from your lender and saying that the market's basically tanked in real estate and we're going to drop your line of credit by $25,000 or freeze it completely. That happened to a lot of my clients where they got their line of credit frozen. That can never happen with a reverse mortgage. In fact, it's got a growth rate. So I'm going to go back to your example. If you're, say, 62 years old and your home's worth $625,000 and you're fortunate enough to have paid off a mortgage and you have it free and clear, you can put a reverse mortgage on your home, a line of credit for about $315,000. Granted, the property and you qualify for that. So $315,000, and you just leave it alone because your very astute CPA and estate attorney said it's a good idea to do so. 20 years goes by, you're 82 years old, and during that period of time, you've watched this line of credit grow. At that time, that line of credit is now $1,019,000 that you can access and draw against your house. It's not affected by the market, real estate market, and it's going to grow. Now, how we come up with that number is called an expected rate. And FHA gives us that rate to try to determine where interest rates are going to go. The growth rate on the line of credit right now is just under 4%. Yes, Frank?
I just wanted to highlight, you get the reverse mortgage, you lock it in, you don't use it, and how much you can borrow against that line of credit keeps growing every year. So it really goes to your point. You can have that reverse mortgage, but you don't have to use it. It just stays there. It's kind of like almost a rate. That is really the loan of last resort, but in a different way. That's the rainy day loan,
Exactly.
just in case.
And what we're seeing is people using it for planning for long-term care, because long-term care insurance is so expensive, so they're essentially self-insuring or supplementing their care policy. Or, you think of an emergency fund. Something happens and you go to your portfolio, but whenever there's an emergency, it seems like the market's down, and you have to pull it out when the market's down. And you don't want to, because you know it's going to rebound. Well, you use the line of credit, market rebounds, you pull it out of your portfolio and pay that off. Emergency solved. It gives you options. So, number 2, a reverse mortgage can be used to purchase a home. We're going to use that same $600,000 scenario. Same family, free and clear. But they want to downsize or right size closer to their children and get to a 1-story. And so they sell their home, they've got the $600,000, and instead of buying the next home that is $600,000, they use a reverse mortgage to purchase it. In doing so, what they're doing is putting about 50% down, that's $300,000, using a reverse mortgage for the remainder and putting $300,000 in the bank. So by selling and buying with reverse mortgage, they were able to create liquidity of $300,000 and still not have a mortgage payment and move to where they wanted to. So they're not locked into that home, a 2-story that's next to the freeway.
And if you're working with your tax professional and your real estate professional, you're also structuring it so that you can port your property tax rate to the downsized, to the right-sized home. So you're not going to get killed in property tax also.
Yes. You look like you have a question.
If you have a rental property, not your primary residence, can you get a reverse mortgage?
No.
The question was, could you get a reverse mortgage on your rental property?
The answer is no. FHA loans, all government loans except one exception, are for primary residence. Yes.
So you said you can buy a home, but I thought, at least what I read about reverse mortgages, you had to live in a home that you had a reverse mortgage on.
That's correct. If you were, in other words, you're selling and you're moving, right-sizing to live next to your children to get to a 1-story, you're purchasing the next home as your primary residence and using it.
And you can sell the one you have the reverse mortgage on.
Well, yes, that can happen. If you had a reverse mortgage and you had equity and you sold that one to buy another property, you can buy with the reverse mortgage.
And you port the property.
No, yes, exactly. You do port the property taxes.
Or let me give you a home.
So you're paying off the reverse mortgage on the sell and using a reverse mortgage on the purchase, and you can do that.
But let me give you another home run. You own your home free and clear. But it's not in the right place, or it's just too doggone big. It's really for a family with kids running around, and you want to right size your home. What's to stop you from going ahead and buying a new primary residence using the reverse mortgage, but keeping your old home as a rental property to increase your retirement income?
Are you saying that they're buying an investment property?
No, they're buying a new residence, and they're using the old residence now as they're converting it to a rental.
Can't do that.
Okay.
12 months. They're out of that house. It's no longer the house that they used to purchase their primary residence that they pulled the reverse mortgage on to buy the next one. That one.
What I'm saying is they leave their old primary residence. It's gone.
Free and clear.
It's free and clear.
Right.
And now they buy a new house. It's going to be their primary residence, and they use a reverse mortgage.
Absolutely. I'm sorry.
And now they've got the rental income from their old house to augment their retirement.
Yes. I've had realtors ask me, they're only clearing $200,000. I can't find them a house for $200,000. And I'll say, can you find them a house for $400,000? Absolutely, depending on the areas, their outlying areas. And they can do it. It's doubled their purchase power, or conversely, creating liquidity by selling and then buying. Yes?
Are there fees associated with reverse mortgage, title, escrow?
Yes, yes, yeah. And depending on how it's structured, there can be lender credits, but not on a purchase. A purchase is a little bit different. In fact, when we get into a purchase, I always call the listing agent and the selling agent, and I need to know who that escrow officer is because I want to make sure that they're well versed. If not, we're going to get them up to speed really quick, so there's no mistakes made with the reverse mortgage on a purchase. Typically, I like to recommend an escrow company where the escrow officer is very experienced in reverse. The agents don't have to be so much, but the escrow officer has to be, or should be. Yes?
So this line of credit grows obviously based on the appreciation of your property?
No. It's on a growth rate. And the growth rate is determined by whatever the current interest rate plus the mortgage insurance would be. And given today's rates, that's just under 4% mortgage insurance and interest rate. Doesn't mean you've pulled the money out, but that's how they determine it. Now, the property value could plummet, and you still have the growth rate on a line of credit. So it's another way of protecting your equity even if the property falls in value. And that's why some people do it, just for the equity protection. I lost it all in my house, but I can still pull it out. Yes.
This is mortgage insurance. You're talking PITI, or you're talking PMI?
It's, well, PMI is private mortgage insurance. Mortgage insurance was basically originated by the government, and that's where FHA comes involved. There is mortgage insurance once you pull it out. It's not an out-of-pocket expense, it's an accumulative, just because you're not making mortgage payments, so interest in mortgage insurance is accumulated when you pull it out and use the funds.
So I'm confused at how is that mortgage insurance that's different than State Farm home insurance?
Yes, it is.
So
What mortgage insurance...
Is being insured and how are they going to get the money back? Or?
Exactly. What FHA's I know you came to...
Because I've been in the mortgage industry about 40 years, and
Okay.
there's always this.
So you have private mortgage insurance. It's similar to private mortgage insurance, but it's the government that's the insurer.
The private PMI was always required like on a 90% loan. If you're doing a 50%, 40% LTV on the money that you're using,
Right.
trying to borrow, and that's a no-brainer in terms of
Well, let me explain it.
hurt on the deal.
Well, let me explain it. You could, okay, you get the money, let's say you're 62, and you live till you're 110. And at a certain point, if you've pulled all the money out, most likely that mortgage is going to be greater value, you're going to be upside down on the property.
Well, that's hypothetical.
Well, that's why they do it. And that's, let me put it this way, without the mortgage insurance, this program would not exist because no investor would put a mortgage in place that's negatively amortizing indefinitely. And one other thing that I want to point out on the mortgage insurance, it makes this loan a thank you, who said that? Thank you. Non-recourse loan, meaning that if that happens where the mortgage is worth more than the home, the lender can never go to the estate. You could have a $2, $10, $20 million estate, and that property, if it's upside down, they can never go to the estate. Because you're essentially borrowing against the property if you're not making a mortgage payment every month. If you do that with a conventional note, that's a recourse action.
And remember what Kurt said before. You start with a $300 and some odd thousand loan at age or line of credit at age 62. By the time you're 85, it grew to how much?
$1,019,000.
And we have a bad year and the house is only $600,000. Okay, that lender's going to take a bath of over $400,000, right? Wrong. They've got the mortgage insurance, and that lender cannot come after you, cannot come after your surviving spouse, cannot come after your children. That's what that mortgage insurance is there for. One more question on mortgage insurance, and then we've got to get on to taxes.
What would the percentage then be revealing the amount that you borrowed?
Outstanding. So if you have a line of credit, but you've only borrowed $50,000, it's under $50,000.
So what's the percentage? And it's 3%, 8% of the amount borrowed is your insurance fee?
No, the mortgage insurance is 1.25%.
Okay. So talk to us about the mortgage insurance deduction and mortgage interest deduction and how that all works.
Okay. And we're going to be here afterwards, so I'm going to answer a lot of questions. But because you're not making a mortgage payment as you go along, if you pulled money out, you don't get a tax write-off on the interest on a monthly basis or annual basis. At 1098, you're not going to be able to use at the end of the year. And that's the one thing about a reverse mortgage that's always bothered me. I look at it and I'm like, I want to be able to use this interest deduction, but I can't. What happens is when the reverse mortgage is paid off, you're going to get a final 1098 that gives you that accumulated mortgage interest that's accumulated over time. And that's really what Frank is here to talk about. This is the idea that he introduced to me at a breakfast meeting on a napkin. It blew my mind, and I said, is this legal?
So he's not going to trust the attorney. He asked the accountant.
And I said, have you run this past Tim? He said, absolutely. And he enrolled agents, board, and a few other people. And this is what got me involved with them. It got me really excited. But I'm not licensed to talk about taxes or estate planning, so I'm going to turn it over to Frank.
Okay.
Yes?
On the reverse mortgage, you're sort of treating it like it's just like an equity line.
It can be.
But you can take that money and divide it into so many months and have it just basically pay you $2,000 a month.
You can do that too. There's a lot of scenarios that we can go over those individually. I don't want Frank to jump in.
This is something I should probably raise right now. You all have a card that has a ticking tax bomb on it. And it would say, and it says there that you'd like to have a consultation with either me or Tim or Kurt, depending on what your interests are. Please, you can just fill that out, and really what we need more than anything else is just your name and your phone number, and check the boxes as to who you'd like to have a consultation with. And we'll be happy to make sure that that card gets to one of the three of us, and that we have that chance to talk to you about your own particular situation. Because we're talking about concepts here. Each person's situation is unique. Okay, let's talk about this. Let's talk about the Smith family. Really creative, right? Okay, what we're talking about is IRD, DRD planning for all the tax nerds in the crowd. Are there any tax nerds in the crowd?
Besides?
Okay. What is IRD and DRD? IRD is income in respect to a decedent, meaning that if the decedent would have taken it, they would have gotten it taxed as income. What is an IRA? IRD, income in respect to a decedent. What's DRD? A deduction in respect to a decedent. Meaning if the decedent would have had to have paid this stuff, they would have gotten a deduction for it. Here's where most people mess up. Mom or dad, or mom and dad, had a mortgage. And then mom and dad pass away. What do the kids do? They sell the house, they pay off the mortgage balance, and they go their merry way with whatever equity is left along with the other assets in the estate. Why is that such a mistake? Because they left the deduction on the table. They didn't take the mortgage interest deduction against the IRA. That's the key. And also, I saw the light go on. Yep. All right. That's the key. These kids inherited not just the house, but also the IRA. And instead of offsetting, instead of taking the money out of the IRA and paying off the interest portion of the mortgage and then selling the house, they just sold the house and paid off the mortgage and left that beautiful accumulated amount of interest deduction on the table. And I've got to tell you, if you ask my daughters, affectionately known as Malibu Barbie and her little sister Skipper, what they can tell you about their father, they will tell you that their daddy is notoriously cheap. The idea of leaving a deduction on the table pains me to my soul. So we want to make sure that we've taken the full deduction against the income that's represented by that IRA. Let's take a look at an example. The Smith family. By the way, these are not my slides. Kurt is just a PowerPoint nut, and he loves cartoons. So Kurt made these slides for me. This is the Smith family. They're wonderful. You gotta love these kids. They got married. They're raising a family. They were high school sweethearts. They got married in 1964. Seems like a bazillion years ago. But they still just, she's the apple of his eye, and vice versa. They have, in 1966, they have 2 kids. I don't think they had them both in 66, but they could have. They could have been twins.
They're twins.
So we got those kids. Woo! And this is where I love it, because Linnell was not going to let this family happen without Rover. Gotta have the dog. So there's the Smith family. And they're living large. They're doing pretty well. They bought a home. They invested in their retirement. They've got a little nest egg going on there. And in 2006, they're both 62 years old, and they were able to retire. Pretty good, huh? All right, let's see what happens. The home value was $600,000, and their equity in the home was $398,856 because they have a mortgage against it. Their mortgage is about $201,000. It's at a time and under a pretty decent interest rate. But their mortgage payment each and every month is $2,147.25. Sounds pretty familiar? Pretty average for that kind of family? So we're not talking about, living really large, but we're talking about a really nicely done job with the Smith family. All right, they have an IRA of $500,000. And they would love to make this IRA last their lifetime, and they would love to leave something for their kids. All right, they've done fine. They're good. And I'll tell you what they're going to do. What most of us will do is we'll keep the loan in place. We'll keep making the mortgage payments. We'll take the money out of our IRA nest egg to make sure we can make the mortgage payments. And honest to goodness, if that's what the Smiths do, they are going to leave a ton of money on the table. Watch. So we did that, yeah. If they did that 8 years and the Smiths suddenly get into a car accident, it's now 2014, what would have happened if they would have taken the money out of their IRAs to pay the mortgage as it went along? Okay, this is what their estate would have been worth. The equity in their home would have increased because they paid down the mortgage. So now it's up to $410,000. The IRA would have increased because, okay, they did take the mortgage payments out, but they really didn't have to take that much out. But oh yeah, the kids can sell the house and pay no capital gains tax because they've got to step up in basis when mom and dad died. Tim's very happy about that. I know. Believe it or not, this for a CPA is the happy face. Had to say it. Okay, but the IRA gets taxed. And if the kids are at the higher tax brackets, at 35% federal, the 9.3% state or what have you, the after-tax IRA, they're going to take a hit of about $260,000. Ick. Which means that the kids are going to inherit the total of $736,000. Not bad, but it could be better. Let's change a couple of things, just for fun. Okay, how are we doing so far? We all getting it? No tax loss on the equity on the home because we got the step up in basis. IRA, we're going to take an income tax loss on whatever's in that IRA because the kids are going to have to pay the income tax on it. So now there's your net, $736,000. Let's change it a bit. Okay, let's go. Now they're going to use a reverse mortgage. They're going to stop making that $2,147 a month payment. They're going to let it enhance their lifestyle. And what we're going to do is we're going to offset IRD against DRD after they die. And I'm going to show you how to do it. Okay, if they did that, here's what they've got to do. Mom and dad are gone. What we want is we want the kids or a kid who's inheriting that IRA to live in the house for 2 weeks and not pick up a hammer. Why? We want it to become their principal residence. 2 weeks, that's all it takes to establish a principal residence. 2 weeks. They're going to change their driver's license, they're going to change their voter registration, they're going to change the utilities into their name, they're going to tell the post office this is where I'm living, but they're not going to touch a hammer. And the reason they're not going to touch a hammer is if they touch a hammer, then they are technically not living there, they are readying it for sale. Oh, okay. I told you there's a trick here. W.C. Fields was on his deathbed. Hated children, didn't like God much either, and he's on his deathbed, and he's wearing his gown and he's wearing his cap, and his uncle comes to visit him, and when his nephew comes to visit him, he looks at him, and Fields has got this huge leather-bound family Bible in his lap, and his nephew says, "Uncle, what are you doing?" And W.C. Fields looks up and wheezes, "I'm looking for loopholes." That's the loophole. You live in it for 2 weeks and you don't pick up the hammer. You make it your personal residence. Why? Because now, in that year that my parents died, I lived there, which means that any income I take out of that IRA is IRD, income in respect to a decedent. And paying off the mortgage, paying off the reverse mortgage on the house is now DRD, deductions in respect to a decedent. What can I do? I can now wash the IRD against the DRD. Would that happen? Now the equity wouldn't grow in the house. We'd only have $287,000 of equity. We're just going to keep it where it's at. The IRA though, because we didn't take money out of the IRA to pay the mortgage, that IRA grew. And because Mr. and Mrs. Smith were not yet 70 and a half, it grew tax-free, or tax-deferred. I can't say tax-free. Tom Gunner, I don't want to say that. Tax-deferred, and there it is. So because of that growth, we're going to still have to pay taxes on the IRA, but because of the tax effect of taking the DRD, the tax bite isn't that bad. What's left after the tax bite is not what we had before. Remember in our previous example, let's see if I've got this in this previous example. Oops, there we go. we had only $325,000 after tax on the IRA. Here, we're going to have $607,000 after tax in the IRA. So how much did the kids inherit? $895,000. We just made almost $160,000 more because we washed IRD against DRD. Yes, sir?
Now, the increase in the IRA is due to having invested in some kind of fund.
What I'm doing is, you're just saying, okay, what did you just invest in? I am using the S&P 500, and I'm using dividend reinvestment. Why? Because you don't get taxed on dividends when it's inside of your IRA. So I'm looking at the total return. So if you bought an index stock fund, the S&P 500, that's what your combined rate of return would be someplace around 10.3%, actually 10.1% from 2006 to 2014, even with the mortgage meltdown.
The difference between this scenario and the previous one that they took out the max they could from their IRA to reinvest it?
No, what they did is they just left it in there. They just let it cook. It simmered. It didn't come out.
They hadn't hit age 70 and a half yet.
Okay. Now, we have actually, at our office, we have developed spreadsheets where we can do the entire algorithm based on however old you are or however old your parents are and however old you think you're going to be when you answer the great roll call in the sky. We've got it all worked out there. And we've figured out exactly what the tax rates are going to be, what the increase rates are going to be. If you don't like using the S&P 500, we can plug in a different rate of return instead of the 10.1 or the 10.3. We can plug in 6. We can plug in whatever so that we can model this better for you. This is another thing that made Kurt very, very happy. Is we had to scrape his brains off the ceiling when he took a look at these spreadsheets. Okay, but there's an even better play than this. Get ready. Because what would happen if instead of making that mortgage payment, what we did was we took that $2,147, if we didn't need it for lifestyle, and we turned to our financial advisor, and there's a couple of you here in the room that I know really, really well, and I said, do me a favor, invest it for me. Only in this, invest it in a stock fund that's not in my IRA. Invest it where you're going to make it grow. And in here we're going to use a different rate of return. We're going to use the one where we're actually going to take the dividends and pay the taxes on it. But remember, those stocks that your investment advisor is now making bigger and bigger and bigger, we're going to get a step up in basis. We're not going to pay capital gains after you pass away. Your kids aren't going to pay capital gains because they get the step up in basis when they liquidate that stock portfolio. This is happy time. Well, your passing away is not happy time, but saving on tax is happy
Your beneficiaries, yeah.
Okay, here we go. Let's take a look at what's going to happen. What would happen here is the equity in the house stays the same, 287. The IRA stays the same, after tax 607. But look what happened, 8 years, $2,147 a month invested in the S&P. And there, without the dividend reinvestment, the rate of return is not 10.1 to 10.3, it's about 8%, because the average dividend rate was a little bit over 2%. So what's going to happen to that stock fund? The stock fund is going to be $433,775, simply investing $2,147 a month for 8 years and letting it marinate. This is on the S&P 500, mind you. But what's the total value of the estate? What's the total net increase over what that estate used to be when we didn't use the reverse mortgage? The total increase to the estate, the total increase to the kids is $592,000 increase and no change in mom's and dad's lifestyle. Okay? That's the play. That's really using a reverse mortgage and using the tax aspects of the reverse mortgage to best advantage. Tim, did you want to comment on this at all or just play with it at all?
No, what I would add to everything that Frank has said is it's absolutely never as easy as these examples. When there's more than one child or one beneficiary that you have to worry about, there's going to be dissension. And so it comes back to the need to plan and to document so that you can control from the grave.
And it takes getting your kids on the same page so that they understand this stuff, because again, I think that all three of us have seen one of the tragedies we see is when the family does not teach the children about these concepts, and now you have adult children who don't have a clue, and they're being asked to make huge financial decisions, and they make them quickly and they make them without proper training. So let's see what I've got here. Let's see. Let's bring this all together. Just this example. Here's our comparison. In the traditional way, where we're not doing any kind of planning, the total, that's the net after tax to the kids, was $736,000. There's nothing wrong with that. That's pretty doggone good. The Smiths did really well. But if they would have used the reverse mortgage, even without reinvesting the mortgage payments, they could have increased that by 21.61%. They could have increased it by $159,000 with really no change in lifestyle whatsoever. Probably an enhanced lifestyle, because with a reverse mortgage, remember, they don't have to make that $147 a month payment. But you use the reverse mortgage plan and you invest what used to be your mortgage payments, there's the home run. There's where wealth really accumulates, and where reduced taxed wealth really accumulates. So, we've talked about four strategies. Rolling that 401k, 403b, 457 plan into an IRA, correctly designating beneficiaries. We've talked about the reverse mortgage plan, and we've also talked about making sure that we don't make the big RMD mistake today. Questions, comments, moans, groans, gripes, complaints, we're here for you. Any questions? Again, if you'd like to talk to each of us or any of us individually, our firm, what we're doing is we're actually doing an estate review with a comprehensive IRA review. It's a paid consultation. We put a couple of hours into these things and really dig deep. Tim, I know, is one of the, to tell you the truth, he's my tax guy. So he is one of the best tax people I know. And Kurt is available. I don't think you're going to find a whole lot of people who know more about conventional or reverse mortgages than Kurt. So please, go ahead and use that card and ask for that consultation. And if you'd like to ask any further questions, just want to ask them privately, we'll stay around and we'll talk as much as you need. Oh, and any last questions before we break?
I was just going to ask about the SEP IRA, because that's the decision I made. It's a SEP, and
yep.
It differentiates between what you presented this evening.
It doesn't really differentiate. We're still talking about the same types of strategies. So again, it's really the entire retirement plan gamut. If I had to say what's my favorite, it's probably just the plain up traditional IRA. By the way, what we didn't talk about here that we do talk about in greater detail is sometimes taking more out of your traditional IRA and doing a Roth conversion. So there's all sorts of other strategies we haven't even touched on tonight. Other questions before we break? Thank you all for spending time with us tonight. Remember that your DVRs are set for the basketball game.
Yeah, they put you to sleep.